Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a very brief look at some financial results of Prestige Holdings Limited for their fiscal half year ended May 2023. The group would have reported much improved earnings, of course, and that would be welcome news to investors. And we're going to very quickly touch on NIF, for which we at Bourse have been getting a couple of queries given the upcoming maturity of the Series A bond. So let's get straight into it and looking at that Prestige Holdings Limited or PHL performance for that half year 2023. As mentioned, the group would have reported a diluted earnings per share of 32 cents, which was an 84.5% increase from the 17 cents per share recorded in that prior comparable period of 2022. Now, driving that performance was a very outstanding increase in total revenues of close to 25%, moving from 511 to $657 odd million. Gross profits increased 20.9% from $167 million to just around under $202 million. Overall profit before taxes increased from $17.3 million to $30.3, a 75.2% rather increase in PBT, and profit attributable to owners increased at 85.5% level from $10.8 million to $20.1 million at the half-year mark. So certainly welcome news and good reading for shareholders of Prestige Holdings Limited. Again, when we take a look at that revenue trend, it has been very encouraging news very encouraging results over the past few years, from the half year of 2020 and 2021 moving on to the half-year period of 2023. And that really would have been driven by a strong recovery and reopening and continued opening rather of existing stores, as well as new store sale growth. In half-year 2020 and 2021, of course, investors may recall there would have been significant shortfalls in terms of the number of allowed open days due to COVID-19 restrictions. That is certainly a thing of the past for now, and we see that would have been reflected in continued very strong revenue growth for Prestige Holdings. In fact, at the half-year mark, that 657 odd million in revenue actually eclipsed its pre-COVID half-year revenue of 538 million. So certainly very strong results for Prestige Holdings. From a margins perspective, and that means translating every dollar of revenue into dollars of profit, we can see that there has also been notable improvement. At the gross profit margin level, there was some decline from 32.7% in that yellow to 31.7% period on period, again attributable to perhaps inflated costs of input raw materials. However, at the profit before tax margin level in that green segment, we can see that particular profitability margin increased from 3.4 to 4.8%. So certainly a very strong improvement, which in other words means that for every $100 generated in revenue, Prestige moved from creating $3.4 of profit to $4.8 of profit out of that same $100. So certainly, again, encouraging reading for PHL investors. So at a price of $7.95, Prestige Holdings or PHL is trading at a price earnings ratio of 11.1 times, below the sector average of 13.4 times, and offers a dividend yield of a relatively attractive 4.4%, particularly when compared to that sector average of 3.1%. So on the basis of improving revenues, improving margins, as well as continued new restaurant openings, particularly as the group would have referred to in the Guyana space, as well as a couple new Starbucks franchises opening within the Trinidad and Tobago market, Bourse is maintaining its market weight rating on Prestige Holdings Limited for the time being. Now, turning very quickly to the National Investment Fund Holding Company Limited, or NIF. Investors would be aware that this investment would be relevant based on its three series of currently outstanding bonds, the Series A, B, and C, with the Series A expected to mature in just a couple of days' time, August 9, 2023, so just over a week from now. Now, investors have been speaking about or asking about the prospects of this bond being repaid. In fact, there was some fairly curious trading in terms of that price, trading below as low as 90 cents on the dollar, so close to maturity. Well, have no fear, the NIF remains, based on our analysis, very, very well collateralized, with just about $9.2 billion at year-to-date in the market value of its portfolio of securities versus an outstanding which is an outstanding debt obligation of just about $4 billion, which means that its collateral to debt ratio is about 2.3 times, which is actually higher than when it would have started at just 2.0 times at its inception. Now, the refinancing of the bond, that's another question. In Caracas's rating release on NIF recently, it was noted that there was a proposed Series D of NIF bonds, which was going to be issued of up to $1.2 billion, which coincidentally is the amount of the maturing NIF Series A. So we have very few concerns as to whether or not there will be repayment any issues or any repayment issues related to that Series A of NIF. So rest assured that that will happen, and in very, very good time. Well, that's it for this week's edition of the Bourse Report. You can give us a call at 226-8773. Email us at invest@boursefinancial.com, and of course, check out our website where all of our research is absolutely free at bourseinvestment.com. So however you choose to spend your emancipation holiday, do it safely and enjoyably, and we'll see you next time on the Bourse Report.